Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. Over the next 20-25 minutes, we'll talk about a particular topic that has recently been of significant interest. I think the saying of don't put all your eggs in one basket is conversely applied by a few people as well, is that put all your eggs in one basket and watch that basket. Now, depends on how you're viewing that basket. Let's assume you do believe that diversification is important, then you could diversify within asset classes within your portfolio. You could also diversify by having different kind of funds, and you could also diversify now, even if you're an Indian investor, by investing in global equities. How to do that? That's the key question. Now, for all those who thought that global equities might be not as great as the Indian equities, look at the performance of some of these companies. Apple, I mean, ignore the market caps, which are great, which are very high, and Indian companies can't dream of reaching there right now. But it is the 10-year CAGR returns of these giants, which is interesting. Apple, 10-year CAGR 31%. Alphabet, Google, 10-year CAGR 22% returns. Not mean at all. If you are lucky enough to have been invested in Amazon, through whichever way you would have been, you would have enjoyed a CAGR return of 43% over the last 10 years. But you and I both know that it's difficult to invest directly into some of these funds. You can route your investments through Singapore, open an account in one of the geographies abroad, through various brokerages, but that's a very expensive process. So is there a cheaper and a better way of investing in these companies? Is there a more short way of investing in these companies, because you leave the decision to experts who are tracking these companies? I think that's the topic of today's discussion, which is global diversification. And to talk about that, Radhika Gupta, CEO of Edelweiss Mutual Fund, joins us right now on the show. Radhika, good having you. Thank you so much for taking the time out.
Pleasure as always.
Now, are you also of the camp who believes that while people are investing in India, Indian equities, and they are great to invest in, it might not hurt to take some bit of global exposure?
So I think firstly, I'm glad you're doing a show on this topic. And I've always thought that diversification is a very, very powerful construct, to take off from your word. Now, if you look at most investors in any market, and I spend a lot of my career overseas, very few HNIs would say, I want all my exposure in a single country. In India, the international fund story has perhaps not taken off as it should have for whatever reasons. But I do believe very importantly in the power of diversification. So I think 5 to 10% of one's portfolio allocation to another geography, and there are many reasons I believe, that one should do that, which we can talk about. But I do think that that's a very, very powerful construct for any investor, especially when it's not hard to do.
So why?
So I think there are three reasons, Neeraj. One is access, second is diversification, and third is currency. You talked about the fact that, while we talk about the great Indian consumption story, a lot of what we consume is actually foreign. I mean, your phones are Apple phones, or they may be Samsung phones. They are all foreign companies, foreign cars, Honda, a lot of the web services. You shop online on Amazon. Now, getting access to these companies as a standalone investor through your brokerage account, investing overseas, choosing a single stock, that's hard. International funds solve that access problem. Secondly, there's that very powerful point about diversification. Now, we talk about the fact that no single asset class is the best performing every year. In 2014, in dollar terms, Indian equities were the best performing asset class. In 16, actually, they were the worst. US equities were one of the best performing asset classes. And in 17, you may be surprised to know, China was one of the best performing asset classes. So just as no single asset class, debt or equities, is the best performing, no single geography is the best performing, which is your argument for diversification. The third one is currency hedge. I think the rupee naturally depreciates a certain amount a year. International funds offer superb diversification to a declining rupee. And for many of us who may have expenses later in dollars, you want to send your kid abroad for a foreign education. If you plan to save up $100,000 today, that $100,000, because of declining currency, may not be adequate a few years down the line. So invest it in dollars.
Now, how would this work? I mean, how do you explain this method? I mean, let's say if I have a plan of sending my kid 15 years down the line, 10 years down the line in the US, I mean, how would investing in an international fund help me?
So an international fund basically insulates you. It benefits from the fact that the rupee depreciates. All your other investments are in Indian rupees. This is an investment. When you park money in an international fund, you park 1 lakh rupees or 1 crore rupees or whatever it is. It gets converted to dollars, it gets invested in dollars, it stays in dollars. When you need it back, you get it back in rupees, but you're protected from you're benefiting actually from the rupee depreciation, which is, by the way, 2.5% a year on a historical basis.
Yeah. So would you go as far as saying, Radhika, that this investment is probably for people who got specific needs, or anybody who is looking at a complete mutual fund portfolio, which would have some bit of debt funds, some bit of the funds that you like investing in a meaningful way, hybrid and balanced funds, or pure equity funds in India? Yeah. But in order to complete that bouquet, maybe an exposure to international funds would also be a necessity. Would you go as far as saying that?
Yes and no. So certainly it's for people who have a need, for people who have global expenditure, no brainer. I think obviously it's not the first thing you're going to do when you have a mutual fund investment. You know, I'm not going to go forward and say that. But yes, is it a complete part of a mutual fund basket? Absolutely. Just like fixed income is a part, it's a complete part. What I would encourage people to do is that international funds are not well understood. Now, thanks to mediums like this, before investing in it, work with an advisor and thoughtfully decide what market you're going to invest in, what fund you're going to invest in, what the risks are. So before you make any investment in life, one should be very confident about why one is investing, what one is investing in, because you don't understand the Chinese market, perhaps as much as you understand the Indian market. So when you're doing that's US value, so that's dedicated to value investing in the US. So that's a really nice one. Then you've got a Greater China Fund. So that covers the whole China, Greater China, Taiwan space. Incidentally, China has been a terrific market over the last few years. It's also a consumption-driven economy, so you've got that. You asked about specific themes. We've got a fund in the ASEAN category, so that covers the major Asian economies. And we've got a fund that is Europe dynamic, so that covers Europe. And then we've got a fund that's emerging markets. So different blocks and categorizations are covered, and our suite, as I said, is not unique. There are, funds that cover mining. There are funds that are more sectoral and thematic. There are funds that are more geography. But the range is very, very vast. As I said, 80% of the world's geography is covered today.
And is it as easy for an Indian investor to invest in an international fund as it would be in say, a domestic fund? I mean, what do I have to do in order to do this? Let's say I want to invest into the US dedicated fund and the ASEAN fund, because I believe these two economies could do well. How do I go about doing it?
It's just like a normal mutual fund investment. You invest in an equity fund, you invest in a hybrid fund, you invest in a debt fund. International funds are just the same. You work with your advisor, you put in an application, the KYC process is the same. You make an investment, you get allocated some units, there is an NAV, there is a fact sheet. It is no different actually than investing in an Indian mutual fund. It's just that the securities that you're investing in happen to be global. Bunches of Indian asset managers take different approaches to global investing. Some work and do the investments locally. Some work with foreign asset management partners who may have the expertise to do this better. But either way, from your point of view, it's actually just the same.
Okay. And is there some minimum thresholds that an investor needs to invest in order to get exposure to these funds, or the bare minimum investment is whatever, 500,000, 5,000 as the case may be?
It's just the same as it is in an Indian, in a regular Indian fund. It's actually no different.
So you're saying that what is available to me on the Indian shores,
yes,
in the same way it's available for me on the global shores as well.
In fact, international funds have the benefit of debt fund taxation, so you also benefit from indexation.
That's actually come to that.
Yeah, so you have the benefit of indexation also over 3 years.
Could you explain, I mean, how does the taxation for these categories work versus, say, a normal equity fund which invests in Indian equities?
So normal equity funds are subject to long-term and short-term taxation. Short-term taxation, as we know, is 15%. Long-term taxation is 1 year, and that's 10% for normal equity funds. International funds are treated like fixed income funds. So if you've ever invested in a fixed income fund, over 3 years is taxation with indexation. Before 3 years is the marginal rate of taxation, or whatever the highest taxation would be for you. So in an under 3-year period, compared to Indian equities, maybe you're at a disadvantage. But in an over 3-year period, and by the way, I believe, just like Indian equities, if you're investing in a market like China or the US, you should invest with a 3-year horizon. You've got the nice benefit of indexation. This is really interesting because prior to the change in equity capital gains, domestic funds were zero in the long term, and these were, whatever they are, with indexation. Now that gap has narrowed, so actually international funds have become relatively more attractive.
Okay, interesting. Now, your team must obviously be looking at these funds very. So how does it work? If I invest in an Edelweiss fund, Edelweiss AMC invests in some funds which invest in equities abroad. Is that how the function works?
So in our case, as I said, people have taken different approaches. We partner with JP Morgan Asset Management, which is one of the world's largest global managers, large presence, 350 folks covering this kind of space. So you invest in an Edelweiss fund. Edelweiss then invests in a JP Morgan ASEAN fund or Europe Dynamic fund, and a team of professionals who's a specialist at Europe or China is then managing your money. So you're also getting actually the best of global knowledge.
Right, and my investment would mirror the NAV, loosely put, of the fund, which is the JP Morgan ASEAN fund, which is open to all investors across the world.
Yes, it would mirror that, except for any expenses that may be charged by the Indian asset manager.
Which is you in
which
this
is
case.
Us.
Are these expenses high?
No, they're actually very, very comparable. So there'll be an expense that the JP Morgan fund will charge, certainly. There'll be an expense that the Indian asset manager will charge. But on a consolidated basis, for the access that you're getting, it's not a very expensive proposition.
Okay. Radhika, this is great. Just one last question. Your team, what is it recommending right now? Is it recommending the US-based funds, the ASEAN funds, the Chinese funds? What is the top recommendation?
So there are two things our team has been talking about. One is from a developed markets point of view. US is an evergreen market. So that's something that one can look at. The second market that one has talked about, and we had some colleagues down from JP Morgan, is the whole China space. Because China is going through a very interesting revival, focused more on consumption as an economy. In some sense, it mirrors India, but it's yet a diversification. So for, I think personally for us, these two are very, very interesting opportunities. We've actually seen a lot of interest in our China fund in particular over the last year.
Wow, so there are a multitude of options that Edelweiss anyways gives, but as Radhika is candid enough in saying, it's not just Edelweiss which is doing this. I think across the AMC platform, a bunch of funds available for you to invest into the global equities. Radhika, thank you so much for taking the time out and being with us today and giving us your thoughts.
Thank you so much.
No, really appreciate this. Well, as Radhika was talking about funds, and as I said, she was candid enough talking that there are a bunch of other options available. Jayesh Khilnani has drawn together a list of options, international funds which are available in India, and what has been their performance so far. Jayesh, what are the details?
So Neeraj looked at some of the funds which have direct exposure to international businesses, and one of the first names that comes up is the Parag Parekh long-term value fund, or popularly called as the PPFAS fund as well. Now this is focused on global stocks and has given you a 5-year CAGR of about 17.1%. Well, what stocks they do or the businesses that they hold are Alphabet at about 8.8% of their portfolio, followed by Facebook, which is nearly 4.4%, and you have Suzuki Motor, which is also in excess of 4% of their portfolio. Now moving on, we have another category of fund as well, which is the ICICI Pru US Blue Chip. Now of course, as the name suggests, this focuses on the US markets and has given you a 5-year CAGR of just about 10.5%, where they hold about 4.86% stake in Amazon and 2.73% in Alphabet, followed by Merck, which comes in at about 2.7%. The last in the list that we have, if we can have that up, so that's the Franklin India Asian Equity Fund, in fact, which focuses on Asia Pacific excluding Japan as a region, which has given you a 5-year CAGR of just over 8%. We are holding Alibaba with about 9.2% stake, Tencent at about 8.2%, and 7.46% of Samsung Electric as well. So some of the funds where you can actually invest and take ownership of these international companies, which of course would be extremely difficult on a direct basis.
Okay, Jayesh, thanks for putting that into perspective. So there you have an idea of what some of the other funds have done. But Radhika told you, remember, that take an advice of a financial advisor who will understand your needs and then put you on into an international fund if need be. Let's get in somebody who's well, an expert in multiple matters really, but on this as well. Tarun Birani, founder of thinkingman.in, joins us right now on the show. Good having you, Tarun. Thanks so much for joining in. To your mind, Tarun, at what stage should any investor think of having an exposure into international funds through whichever route, but into international funds?
Yeah. So on international funds, three important parts. One need to be very clear on. Like any other investments, diversification is extremely important. No country equity can deliver the same kind of returns. Yeah. So we have a lot of data and research to back it that every year the top performer keeps changing. So it is very important for an investor who is looking at a long-term parking of funds need to be diversified across geographies. So let's say in 2016 end we had a demonetization kind of event happening. I think that event has taken the entire domestic economy by a toll. So if somebody was invested into, let's say, outside India, he could have looked at that demonetization would not have affected him. So that is one very big rationale for looking at international investing. And second important rationale for looking at international investing is you are able to participate in true global companies like a Google, Apple, Microsoft, which today sitting in India, in a domestic equity you can't. These are truly global company and they are penetrated. I think 15-20% of their revenue comes from US, 80% is global. So one can participate through this route. And the third important rationale for this is I see Indians have been always very progressive about their kids' education, as well as a lot of funds are required to park outside India. Yeah, so for that part, let's say somebody requires after 10 years some money for their kids' education. That is also a way to look at international funds because everything is available to you there in dollars. So you are participating in the dollar rally in that way. So these could be some way to look at international funds.
Yeah, but at what stage, Tarun? I mean, what I'm trying to say is that here we are telling people, okay, start investing into funds.
Sure.
People have started SIPs maybe a year, 2 years, 3 years ago.
Sure.
Their monthly outgoes on SIPs are also not at stratospheric levels.
Sure.
Should those kind of people also look at international funds, or you should approach international funds after you have a complete bouquet of options which are available in India satisfied? Is there a rule like that? A light rule like that?
So there is no rule like that, but I agree to your point that first get yourself invested in domestic equity. Get yourself firmly rooted there. Once you understand equity clearly, because in terms of international equity, apart from country risk, you are getting into currency risk also. Yeah, so currency risk, while you are entering first, you need to be aware of a concept like equity very clearly. So once you are clear on that part, you have started investing, maybe 3-5 years investing experience has come in, and you have a sizable, let's say, money going in, and I think that time parking a 10-15% of your portfolio into global equities could be something looked at. And there are a lot of beautiful ways to participate in
Please tell us.
In global equities, global investing options. One is RBI has allowed $2.5 lakh under LRS. So under that, any investor can participate outside directly. You can open a foreign broking account which invest outside India, and that could be a start of it.
But is that an expensive affair, maintaining that account, etc.?
I don't think it's a very expensive affair, but the problem is around the knowledge part. So there, I don't think many investors have that kind of knowledge or understanding of that. So the better route could be, the second way could be international funds available in the market. International funds also, you can participate in 3 ways. One is funds which have local fund managers managing equities outside India.
The likes of Parag Parikh, for example?
No, that would not come under that.
Okay, sorry.
Yeah, so the one would be, let's say, a typical fund wherein all the investing options are selected by the Indian fund managers only and invested outside India, 100% owned by that. Second option could be feeder fund options, under which there is a fund, let's say in Luxembourg, Mauritius or somewhere, and you invest in that feeder fund. So there is no direct investing which is happening from India. A fund manager who is looking after that. And the third option could be, since there are taxation disadvantage, I would say, in terms of investing into international funds today, because they are considered 100%, more than 35% invested outside India in a fund. In that case, it falls under a debt fund option. So that leads you to debt taxation. So post 3 year, your money will be available for indexation and all that.
Right.
So in that case, there are some structures which have, so likes of Parag Parikh, what you mentioned, so they come under a typical equity fund, but they invest almost, as we speak, they are 25% outside India. There are funds like Templeton India Equity Income Fund and all those funds which are investing outside India, but they have smaller allocation and they come under Indian equity kind of structure. Other ways in which you can participate in international funds could be themes like mining themes are there, gold theme are there. There are themes like region-specific theme, Japan, China, Brazil. So which country you have, let's say, you feel confident about or bullish about, you can participate that.
Have you participated in these funds at all for your own personal needs?
No, I have not participated myself, not participated, but looking at a very evolved investor, we have looked at clients who had requirement into US, let's say in dollars, money in dollars, we have participated for them into US equity funds and all.
Okay.
Yeah.
A couple of 2 or 3 examples, Tarun, if you can give us as well. So let's say somebody is listening to this program is convinced that, okay, I do want to spread or diversify my risk a little bit.
Sure.
I do want to invest in international funds. I don't have an idea whether China will do well, ASEAN will do well,
Sure.
Europe will do well, or the US will do well. But I want an international exposure,
Sure.
maybe to diversify. What kind of funds would you recommend? I mean,
Sure.
Again, I'm agnostic about whether it's a feeder fund
Sure.
or it's a direct fund or otherwise. All I want is an option which gives me an exposure to the global markets.
Sure.
What is the recommendation?
So before that, I would like to talk a little about the outlook around rupee. That is again very important before looking at international funds. So last 2-3 years, if you look at, our currency has not depreciated meaningfully. And if you look at scenario today, last 6 months, the crude prices have moved in a north range. Yeah? And we don't expect the crude prices to come down significantly from here. Apart from that, the interest rates are also moving on a very, very firm level. So I expect that Indian currency should depreciate meaningfully in times forward, and that gives a very, very strong advantage to investor, at least to earn the currency returns. So I see that 5-7% extra returns can come just by currency kind of exposure. Apart from that, I think for starters, I feel looking at US equity where all these global giants are available, the blue chip ones would be the one I would look at right now, because that gives you exposure to all these kinds of Microsoft, Google, Apple kind of stocks which have a firm global footing.
So what funds are doing this, if you can give me? I mean, I know Parag Parikh invests a little bit in some of these global funds. They probably have Alphabet and a couple of others. But does ICICI approve US Blue Chip Equity Fund does the same?
Yeah, so 2 funds in US Blue Chip, I would look at. One is a Franklin US Feeder Fund. I think that is doing very well. And second fund, ICICI US Blue Chip. So that is not a feeder fund. That fund is entirely managed from India only.
Oh, interesting.
Yeah.
And what is your view on Parag Parikh long-term value fund? They have some exposure to US, not all.
So they have 20-25%. So from a theme perspective, they are value-oriented investors. And their theme has delivered good returns. And I think one can look at that also.
Okay. Any final words, Tarun? Anything that people should keep in mind?
Yeah, so 10 to 15% once you have breached, let's say, 3-4 years of investing experience, and you have a corpus which is meaningful, I think one can start looking at international investing also. And one can start with 10-15% of their currency of their portfolio exposure into these kinds of funds.
Wow.
Yeah.
Okay. Tarun Birani, thank you so much for taking the time out and being with us and giving us those thoughts. That's Tarun Birani of thinkingman.in talking about his thoughts. But with that, it's a wrap on this edition of the Mutual Fund Show. Thanks so much for watching.